Hello and welcome to ETFatlas.com. My name is Jacek Lempart and I'm thrilled to guide you through today's conversation. At ETF Atlas, we host the world's largest ETF database, covering funds from the United States, Canada, and Europe. And in fact, if you can't find an ETF on our platform, probably it's because it hasn't been invented yet. Today's guest is Ramin, whose journey from physics and neural networks to investment education is as fascinating as a market rally after a Fed rate cut. Ramin, for listeners who may not know you yet, could you please introduce yourself and share your story from investment banking to founding PensionCraft?
Yeah, sure. I mean, my background was physics, like you say. So my degree and my doctorate were in physics. And, that was quite a numerical way of looking at things. But I think physics is great because it teaches you a certain way of seeing the world and a certain way of solving problems. It's funny because I often bump into some of my old university buddies, and it is interesting how similarly we see the world. So I think that kind of numerical, objective approach to looking at the world combined with investment is a very healthy one. And I think it's an approach which you kind of like yourself, Jacek.
Before we dive into investment education, what do you see happening in the markets and economy right now? After any major trends or maybe some macro events that investors should pay special attention to?
Yeah, look, I mean, with equity, what we've seen is over the course of 2025, we had a big sell-off due to the tariffs. Now we've recovered very easily where we were before that. It happened very quickly, particularly for the US. And now I'd say that it's pretty much a state of complacency where markets are pricing everything to perfection. The Magnificent Seven are very expensive. The US is expensive. India is expensive. Not everywhere is expensive. Europe, for example, not so much. China is still very cheap. So I think there are pockets of value throughout the world. Even in the US, if you look at small caps, they're still quite cheap. So I think it's not the case that everywhere is expensive, but that's the equity space. And then in fixed income, what we're seeing, which seems to have rattled equity at last, it's often the way things work. But what we're seeing is that the yields at the long end of the curve, so here 20, 30-year yields, in the US, UK, Europe, are all surging upwards. Now, at a certain point, that's going to spook equity markets. I think it's started already. There are various reasons for it, of course, worries about tariffs and inflation, worries about debt sustainability in the US and elsewhere, in France. But there are multiple reasons why it's happening. In a sense, it's a recurrence of the previous status quo, because we used to have a very steep yield curve. Historically, that's the way things go back to when they're normal. But I'd say at the moment, the rate at which those long-end yields are rising may spook markets. But is it abnormal by historic standards? No. You'd expect an upward-sloping yield curve. It's just the rate of increase, which I think is a slightly worrying thing.
I see our discussion today as a kind of investment fundamentals, kind of a mini course for beginners. That's why I wanted to start with the basics. And why should ordinary people even bother about investing? I mean, what's wrong with just keeping money in a savings account?
I don't think there's anything wrong with that. I think for some people, it's a reasonable way to invest. However, the return you get on cash historically has been significantly lower than with bonds or with equity, even more so. So if we look at historic returns from a very famous paper by Dimson, Marsh and Staunton, they publish a yearbook every year, and just Google their names and you'll find it, Global Returns Yearbook. And that goes back to 1900. And it's really interesting if you look at these long-term total returns, so you reinvest the income from each source of return. What you'd see is that equity, on average, generates about 4% more per year than bonds, where bonds would be 10-year bonds. And then bonds generate about 1% more per year than cash. So that's the kind of hierarchy. Now, sure, you could invest in cash, and actually you'd probably beat inflation. You would have done over the last century. But long term, you're going to massively underperform equities. So I think not understanding that could be very costly for investors.
Many people are genuinely afraid of investing, especially after hearing about, market crashes. All the media are talking about it. In your experience, because you have a huge experience in investment banking, how do you help people overcome these psychological barriers?
Well, firstly, let me say that I'm scared as well. I'm quite a nervous investor, and that surprises some people. But every person's got to find their own portfolio that they're comfortable with. Now, for me, I finally managed to convince myself that I should have 100% equity. So for my core portfolio, that's what I've got. I also have like a 10% portfolio, which is just for playing around for fun, where, I could put money into cash, derivatives, whatever I want, crazy stuff. But that's just for play. So for me, it was a very difficult process to go from what was essentially a cash account or bonds all the way up to 100% equity. And the way I approached it was to drip feed. So I took my total investment, and then every month I put a 12th, actually 24th, because I did it over 2 years, into the equity allocation, with the idea being that if there was a crash, I'd have accelerated the money going into equity. But really importantly, you don't step back into cash or bonds. You only move forwards at a steady pace, or you accelerate if markets crash. As it turned out, markets didn't crash, so I ended up underperforming as a result of my caution. And that's what happens most of the time. If you hold money back from the market, the equity market, usually you underperform. That happens about 2/3 of the time. And that's because of the steady upward drift of equity long term. So I think that's how I overcame it. But everybody's got to find their own sweet spot. It may not be 100% equities. Your circumstances may be such that if equity markets fell, that would affect your quality of life, in which case your risk capacity would be low. And so 100% equity would be crazy. Or you could lose sleep if equity markets crash 20%. So then your risk appetite would be low. Or you could be investing over a short period of time. I recently spoke to a lady who has a fairly serious cancer diagnosis. And of course, her investment horizon is shortened as a result. So I think all of these things factor into how you invest. Risk capacity, risk appetite, investment horizon. So 100% equity is certainly not for everyone. But I think the important thing is have a plan and then work out what return you need to get you to where you need to be. It may be that you don't need to take much risk at all. I speak to some people who've got huge amounts of money and who just don't need return. All they have to do is beat inflation. So I think for them, return is irrelevant and they don't have to take a lot of risk. So I think every single person's different. So that's why I think my approach, which is to teach people how to do it themselves, is better than to tell people what to do. Because then, even if they have an advisor, then they can understand what the advisor is telling them and whether it's appropriate for them.
Before we dive deeper into investing, could you please explain the main asset classes? We mentioned already some of them, which are available to investors. I'm thinking here about stocks, bonds, real estates, commodities, maybe cryptocurrencies today, I don't know, cash. What makes each of these different, and how should beginners think about each asset class?
Well, I think of it like animals in the zoo. You go to the zoo and you've got the elephants, they're big and they're ploddy, they move quite slowly. And then you've got the apes who are kind of lively and human-like. And then you've got your zebras, every animal's got its own attributes. And that's why I think being grounded in data is very important. If you want to work out what an asset is like, look at its price history. You'll see whether it's crashy. Does it jiggle around a lot day to day? What's its typical daily price movement? Is it 1%? Is it 10%? And does it crash? And when it crashes, does it recover quickly? All of these things factor into your understanding. And then there's a second level of analysis, which is correlation. So broadly speaking, you could take every single asset and put it into two buckets. One bucket is the risky bucket, and the other is the safe haven bucket. So In the risky bucket, you'd have equity. They tend to be very volatile. Most commodities also fall into that risky bucket. Things like junk bonds, which are actually fixed income, which sounds safe, but they're actually quite risky. They'd fall into the risky bucket. And then we move into the safe bucket. So that would be cash, certainly cash with a guarantee. Short-term government bonds would also fall into that bucket. To a certain extent, gold would also fall into that bucket. But that's why I think if people look at cryptocurrency, for example, which one does it correlate with, the risky bucket or the safe bucket? Well, of course, it's the risky bucket. In fact, it behaves very much like 3 times daily NASDAQ. So it's a very, very volatile investment. Potentially, it's got a high return, but also, as a safe haven, which is some people claim it is, it's certainly not that. So those are the ways I'd approach it. Look at the price history. Is it volatile? Is it crashy? How does it correlate with other assets in terms of the price movements? Does it jiggle with the risky stuff, or does it jiggle with the safe stuff? Because those two jiggle in opposite directions. When people are scared, the risky stuff falls and the safe stuff rises, and vice versa. So understand that relationship and the two buckets, and then that'll start you off into working out, the broad classes of asset. So you mentioned real estate, that falls in the risky bucket. Usually it's quite yieldy, so it generates quite a good income, and it's very tax efficient for generating income. So real estate investment trusts, for example, are structured such that they don't have to pay so much tax, and a very efficient way of earning money from commercial real estate. And then you've got the fixed income stuff. You've got a whole set of asset classes within fixed income. You've got government debt, where the debt has been issued by a government. You've got corporate bonds, where the debt's been issued by a company. Now, of course, the government can print money, most governments, whereas companies can't. So if you're lending to the UK government, well, it's a very safe investment and very low return. Whereas corporate bonds will have to pay you a spread for taking their risk of default. So they're more risky than government bonds. And then some government bonds, like emerging market sovereign bonds, issued by countries like China, Brazil, Russia, those are risky too, because they have defaulted in living memory, whereas the US hasn't, the UK hasn't, or at least not yet. So these are the considerations for fixed income. But most fixed income, certainly the government bonds in developed markets, would fall in the safe bucket. And then for fixed income, there's another dimension compared to equity and real estate investment trusts, which is time. So duration is key to understanding the risk of fixed income. The longer you've locked in a rate, the more volatile the price of the bond, and the more risky and the more duration risk you're taking. And the volatility is directly proportional to the duration of the bond or the bond fund. So again, you've got to understand duration in order to buy fixed income or fixed income funds. But those are the broad categories. And then the commodities usually fall into the risky bucket. Gold is kind of a safe haven one. Although it is quite volatile and crashy, during really bad crises, it tends to hold up pretty well. So I think those are the broad asset classes.
Thank you very much for this wonderful explanation. Let me ask one more question within this area, namely managed futures. Recently, we have more and more ETFs, which means that it's easier to access that specific, I wouldn't say maybe asset class, but this strategy class to even retail investors. And what's your take on this particular strategies as a maybe diversifier in a classic portfolio where we have typically stocks and bonds?
The idea behind managed futures is you pay someone else, which is one of these managed futures fund managers, I suppose you call them, but you pay them your money in order to choose the right direction in the futures market. Now, the futures market is quite special in the sense that instead of buying the thing directly, whether it's gold, bonds, equity, you can go long or short very easily. Furthermore, you can do it in levered form. Futures are just naturally levered. So if the underlying goes up 1%, your future will go up some multiple of that. So they're quite risky, and they're also very easy to go long or short. So if you think a price is going to go down, you'd go short. If you think it's going to go up, you'd go long. And the manager can flip from one to the other very easily. Now, will they outperform just buying the underlying thing? Only if they get the sign right. That's the real problem. So imagine you're a fund manager and you're running one of these managed futures funds. What would you do today? Would you look at the NASDAQ and think, well, it's looking toppy. I think it's going to go up. But who knows? It's not an easy job. But that's what they have to do. Now, some people are very good at that. For trend following strategies, that's generally what these are considered to be. Some people are very good at it historically, but can anyone call it perfectly? No. So I think as long as you've got realistic expectations about these funds, look at their historic returns, look to see when markets reversed, did they reverse at the right time? Because that's what you're paying them for. If there's just an upward trend, well, of course, any idiot can go long in that market. Or if it's going down, they'll go short. It's when the reversals happen that they really earn their money. So that's how I judge one of these fund managers.
Stocks are often called the engine of long-term wealth building. What makes equities so special compared to other asset classes we mentioned before? Is there something truly unique about owning shares in companies, or is it just maybe about taking, in fact, more risk for potentially higher returns?
It's an interesting question, right? I think individual equity isn't great as creating wealth. If you look at the average stock, there's a classic paper by Bessenbinder. The average stock, from the time it's born, when it's first issued by the company in an IPO, to the time it dies, when it's taken over or when it goes bankrupt, on average, stocks have a negative return. So they destroy wealth. And that's something which people usually forget. However, if you buy an index fund, like a global index, the S&P, weirdly, it culls out the really useless stocks by definition. They have to be profitable, they have to be large. And because it's always churning, it somehow manages to capture the entire market. And if a single company goes bust, you don't care. And generally, over time, these are what trend upwards. So single stocks, choosing them is really hard. So active managers usually underperform as a result of that. But buying an index fund, a global index fund or a regional index fund, usually wins. And what's special about these funds and the stocks in them is that they grow their profits. So as the profits increase over time, the price tracks up the profits for the companies. And as long as that continues, the price will carry on rising. Now, not all companies can continue raising their profits, but just look at the composition of the most successful companies in the world. Well, they'll be the leaders in the index funds. So think of it like a race, right? Where instead of betting on a single runner, you're betting on an entire team. And it's like a champion team. And it's like a baton race. As long as it's got good runners, you can win. But if you bet on an individual runner, they could fall over, right? So maybe that's the kind of metaphor to have in your mind.
Around 2-3 years ago, I made some exercise on S&P 500, and I found out that S&P 500, which started in 1957, the original 500 companies from that year till today, only 50 are still in that index. So over 400 companies are gone. I mean, at least from the index. So that also tells us something, I think. You famously said that the best way to invest is to play dead. Can you explain this philosophy and why you believe keeping things simple actually beats complex strategies?
Yeah, I mean, just historically myself, I've discovered that when I try to be clever, markets always turn around and bite me because, something goes wrong. So for example, right, copper. I have a copper portfolio where I said, well, copper's a really important metal. We've got this transition to renewable energy. There are a finite number of copper mines around the world, and the time taken to create a new copper mine is really long in terms of lead time. So finite supply, increasing demand, I'll buy copper miners. But then guess what happened, right? The price of copper tanked, and it has recovered since, but whenever you have a narrative that seems obvious, something usually happens which puts paid to the actual story. So by trying to be clever, I've usually underperformed. Usually it's best to just buy a global index fund and leave it. That's why I've got the fund portfolio, so I can try and beat markets. I know I'm fairly unlikely to do that, but that's why I've got 10% in the fund portfolio, because I think there's only a 10% chance I could beat markets. But I think being dead is great because you don't fiddle with the portfolio. One of the best predictors of underperformance is how often someone trades. And men tend to overtrade more than women. There's some classic papers which show this in behavioral investing. But if you're fiddling, you're probably hurting it. It's kind of like cooking a barbecue where they say, if you're looking, it's not cooking. So, just let it do its thing and be patient. It's very difficult to do.
All right. I noticed from your interviews that most of your personal portfolio is allocated to a global index fund. And for someone just starting out, could you please walk us through why this approach makes sense to just invest money into the global stock index?
Well, essentially what you're doing here is you're buying all of the equity in the world. Not all of it. There's only about 80% of it that you can buy in liquid form where you can easily trade it. But if you can imagine all the stocks in the world in one big bucket, actually 80% of them, you can actually buy that now because that's what an index fund will track. So usually they'll have about 2,000 stocks, maybe 3,000 in them, of the largest stocks across the world. It turns out that because they're usually market capitalization weighted, you'll have more of the big ones like Nvidia, Microsoft, Apple, and those will completely dominate your returns. So these are market capitalization weighted, and you could probably, throw away the remaining, the bottom 2,000, and the returns would be very similar. So it is the top market cap weighted stocks which dominate the return and the risk. But, that offers you a lot of diversification. So let's say, for example, that Nvidia, which is the largest global index component as we shoot this, let's say that Nvidia had a horrible disaster, an accounting scandal, or their chips turned out to have a fundamental flaw. Well, that would really hurt your portfolio. But remember that you'd only lose the weighting of Nvidia. Maybe it would have an effect on other stocks, but that diversification is really important. And you're diversified across countries, across sectors, and currencies. So that's why I think that approach, being maximally diversified, usually works for most people.
Your recent YouTube video covers asset allocation by age. Could you please explain the basic principles behind this approach? I mean, should, for example, a 25-year-old really invest differently than, let's say, a 55-year-old person?
Oh, sure. Because let's imagine you're 20. I mean, it would have been great to be able to have a time machine and do this. I wish I could. But the point is that when you're 20, my mother always used to say this, when you're young, you don't make mistakes, you learn. And that's true in investing as well, because let's imagine that equity markets halved tomorrow. Now, for me, that's a big problem because all of my wealth is in equity, right? So I'm coming to the point where I might need that money. Whereas this person who's 20, they're not going to need that money for 30 years, probably. So for them, this is just a buying opportunity. And if they buy at half the price it was yesterday, well, they're getting a much better bargain and they'll have much better compounding long term. So for a young person, a crash is an opportunity. For an old person such as myself, it's a risk because if I need that money in the next year or two, well, I'm going to have to sell it at a depressed price. And that means that the rate at which I'm depleting my investment pot is greater. It'll be twice as great as it was when it was twice as much money. So that's why they call this sequencing risk. If you have a crash on day one of retirement of, say, 20% or 30%, it'll have a much bigger negative effect on the lifetime of your investment pot than if you have exactly the same size crash 20 years later. So that timing is really important. And this is why people de-risk just before retirement and just after retirement. Because if you imagine the shape of your investments, it's a kind of shark fin where you build up during your youth, you reach a maximum point when you retire, and then you gradually sell down the assets. So it looks like a kind of fin shape. And that point at the top is when you're so sensitive to what happens with equity markets. Because if that crash happens, then you're in big trouble. So by de-risking just before, then you've locked in some of the return, and that way you can ride out the difficult years.
On your website, there is a do-it-yourself asset allocation course, and among many different topics you are covering there, you are also focusing on behavioral biases. And I wanted to ask you, what are the most common psychological mistakes you see, at least investors are typically making, and how can they avoid making these behavioral mistakes?
Well, there are lots of mistakes which we're all programmed to make. I think probably the one which people who are new to investing do the most is to do with this kind of lottery ticket effect, where they think that investing is about high gain with low probability, like gambling. So if I find the 10 bag of stocks, where they're going to go from, £1 today to £100 next year, well, that's the goal, right? That's what I want to do. I want to identify those huge increases. Crypto's kind of like that, where you think if you buy it today, you're going to be immensely wealthy over a short period of time. But I can tell you now that if you're kind of excited when you buy the stock or the crypto or whatever, you're doing it wrong. And you're almost certainly making that mistake. Because investment's not about lottery tickets. It's about harvesting this steady upward movement of equity over time. And time's a really important point. Warren Buffett, for example, the great investor, it wasn't really about his incredible skill, though he was very good at stock picking. I think part of his success was that he was rich quite young. He actually had quite a bit to invest when he was in his 20s. And then he just stuck with it and had reasonable returns for a long period of time. So that should be our approach. Live for a long time, get reasonable returns, and that probably will be a very successful investment strategy. I think other investment biases would involve how you process information. So, for example, anything which confirms your own beliefs is something which is confirmation bias. And often it's the case, if you've bought a stock, you wouldn't want to hear any bad news about that stock. You look at the people who buy Tesla, you can wipe out the earnings of Tesla and it'll still rally, right? It's a bizarre stock. It's trading at 150 times forward earnings. Its sales have been slashed in Europe due to what the CEO's been saying. And you just think, where's the rationality here? And for that stock, I don't think there is much. So that's why, I think you have to have this kind of rational approach to investing. Some of the stocks stay irrational, but on the whole, it's the case that valuation and this kind of looking at the fundamentals of a company certainly helps you. So I think be grounded in data, and that should help you overcome this bias towards confirmation. And if a stock no longer fulfills the narrative, which is why you bought it in the first place, then sell it. Don't be wedded to a stock, because you should see yourself as a curator of ideas, not the owner of the idea. It doesn't reflect badly on you if you sell. It's not a sense of failure on your part. It's just the narrative changed, and you should change with it, with the data that you see.
You mentioned Warren Buffett, and I'm laughing a bit because he said that investing is simple but not easy, and there is truth in it, I think. And by the way, you mentioned also about Warren Buffett that he started very early, and I remember that he started in the 40s, early 40s. So it was the Second World War, with over $100, and that $100 would be worth today, if invested in S&P 500, over $1 million. So that's compounding in practice. Let's get to some practical implementation. We have already some, let's say, theoretical basics behind us. So if someone listening today wanted to make the very first investment, what would be at least your step-by-step advice? Where should they start?
I think understand those long-term returns, because unless you understand what the returns are on different asset classes, you're not going to be able to choose which ones to buy. People often get really hung up on which global index fund to buy, for example, although weirdly, there's only one world to buy. So in a sense, if you're investing over a very long period, it makes the decision very easy. Just go for a very low fee fund. So when you're deciding which funds to buy, if there's a fund that gives you exposure to gold, say, or global equity, and there's 5 different choices, well, clearly you choose the one which has the lowest fee. Why would you pay more to the fund manager to track the S&P? It would be crazy. So I think, the control aspect is important. You can't control the markets, you can control the fees. So find the investment horizon you've got. When are you going to need the money? If you're not going to need it for more than 10 years, then I think put a lot of it into equity if you're comfortable with the risk. If it makes you sick when you see a 20, 30% fall, then don't put it all into equity. Reduce the amount of equity, put more into safe investments like bonds. But those are the primary choice you make is how much in stocks, how much in bonds. And literally with 2 funds, you can build a portfolio which will achieve your goals. A global bond fund, a global equity fund is probably all you need. Maybe a bit of gold later on, but really that's going to be the core of your investments. And if you are going to play around, then do that with the fund portfolio. If you want to take a tilt towards, say, Japan or crypto or whatever it is you think will beat that globally diversified portfolio, then put it in the fund portfolio.
We can have persons listening or watching us from different countries. So I wanted to ask you, are investment principles truly, let's say, universal across the world? Because we mentioned about the global stock portfolio, global bonds and stuff like that. Does someone, let's say, in Germany or France or in the UK or in Poland, if that person need to invest, do they have to do it somehow differently than someone, let's say, in Canada or United States? What about also things like tax implications or maybe some regulatory differences?
I think you hit the nail on the head there, which is that the regulatory differences are probably what's most important. Now, the reason why I say that is because if you've got capital gains tax being much higher than income tax in your country, well, that immediately tells you that if you're investing in a global equity fund, a lot of the return is going to come from capital gain. That's just the way equity markets usually work. Some of it will come from income, but most will be from capital gain. So you have to take that into consideration. In the UK, we're lucky because we've got very advantageous tax-free investment accounts. We've got a personal savings account called an ISA. We've got SIPs, which are personal pensions. And anything invested in those, you don't pay tax on until, for the SIP, until it's withdrawn. For the ISA, never again. So I think that certainly plays a part in what you buy. If it is going to be punitive in terms of capital gain, then you switch to investments which would pay you a higher income, or vice versa. And different jurisdictions are different on that score. I think there's also kind of systemic risk argument here. For example, I spoke to some investors in China a while back. Now, in China, it's potentially true that they're going to have capital controls at certain points in time, and that means that you couldn't freely invest across the world. That's also true in India, for example. I've got clients who I speak to in India who tell me that's the situation. So if only everyone could invest freely, that would be a perfect world, but that's not the world we live in. So you've got to operate within the constraints of your country. currency, I think, is another big difference. So if you live in an emerging market, or actually now the UK, if your currency is seen as a risky currency, it actually reduces the volatility of your investments. Because if equity markets crash, risky currencies sell off at the same time. And if you're invested in US dollar and assets, then when your currency falls, the size of the crash in the US market isn't so bad when it's converted back into your currency, because you get more pounds when there's a crisis. So I think that's important as well. Is your currency a risky currency, which sterling would be? Emerging market currencies also would be risky currencies. Or is it a safe haven currency like the Swiss franc, or what used to be the US dollar, and also the Japanese yen? So I think that's another important consideration, particularly if you're thinking about currency hedging.
By the way, you mentioned that USD used to be a stable currency. Do you think that this time is behind us, that USD will never return to the same role as it used to be?
Look, never is a long time. And who knows what's going to happen after this presidency. But certainly at the moment, what used to be the case is that when equity markets sold off, the dollar would rally because the US was seen as a safe haven. What we've seen recently is that when there's a risk-off move in equity markets, the value of the dollar is also weakened, which is bizarre. I mean, that really is very, very scary indeed, to see one of the biggest safe haven markets in currency no longer behave that way. And the reason is very clear, which is that what were considered really safe institutions in the US, such as the Federal Reserve, the central bank, is no longer independent and unlikely to stay that way, it's looking. And when there's bad economic data, the head of the Bureau of Labor Statistics was fired. So you immediately think, can I trust the data coming out of the United States for non-farm payrolls, for the jobs numbers? You know, all of these unthinkable things are going to weaken the safe haven aspect of the US in investors' eyes. Because you can fool your populace, you can fool the people who elect you, but you can't fool markets.
How much should average individual investor who's very well diversified, let's say having a global portfolio, should really worry about macroeconomic stuff like GDP, inflation, central bank policy? Is it important for such person?
Well, look, you're asking the wrong person.
Yeah, I know.
I love looking at that kind of stuff. So, you know, I could say it's irrelevant. That's not quite true. I mean, if you are an index investor, your mindset is such that you think, okay, I understand macro, but I'm not going to act on it, which is a very strange thing to say. But there are certain aspects of macroeconomics which are very important when it comes to investing. For example, interest rates. Now, if you understand interest rates and the effect of inflation on interest rates and growth, then you can have an insight into whether it's likely that the central bank will raise rates or lower rates. Now, if you buy a money market fund, that's the rate you earn. So by understanding that macroeconomic relationship, you'll also understand, am I about to earn more on my money market funds or less? If I'm going to earn less, then I probably want to move more into risky assets, because that's exactly the kind of environment in which risky assets do well. And in fact, one of the goals of cutting interest rates for the central bank is to make people take more risk and to stimulate the economy. And it works, usually, specifically for the Fed, but also for other central banks. So understanding that relationship is really important. Understanding the shape of the yield curve. You know, should I take longer duration risk in this kind of environment? And that's a real economic question. And as retirees, you're probably going to buy bond funds. So you better have an opinion about that. So do you absolutely need to understand this stuff? No. You could just buy an index fund and leave it for 30 years, you'll be fine. But will you have a richer experience on the journey if you did understand the macro? And will you be more engaged with the world of investment? Yeah. I think it's really important to understand these macro investment relationships.
I wanted to ask you some practical questions now, because let's say we have this person which is trying to make the first steps into investing. And could you explain the difference between ETFs, which are broadly used, and traditional index funds? When might someone choose one over the other?
Yeah, I mean, it's an interesting question. There's a brilliant book about ETFs by Robin Wigglesworth, who, despite his name, is actually Norwegian. He writes for the Financial Times, where he talks about the whole history of index funds. And I think it's important to kind of understand the mechanics here. So part of the responsibility is the index companies. So these are companies which publish an index like the S&P 500, which is published by Standard & Poor's. The MSCI indices are another set of indices. And then the fund managers who track those indices. So they pay a subscription to the index companies, and then they know the recipe for the index, which they then track. So that's true whether you've got an open-ended investment company, an OEIC, or you've got, which is your kind of traditional mutual fund, or whether you've got an ETF. Both of them do the same thing in that sense if they're passive. They take an index and they track it, and they buy the stuff which tracks the index. So if, let's say you've got two different funds, one of them is a traditional fund, an OEIC, an open-ended investment company, the other one's an ETF, and they track the same index, the S&P 500. Now the returns will be almost identical. The pricing will be very different because the ETF trades on an exchange. So you can watch its pricing minute to minute while markets are open. The mutual fund is only traded once a day, and usually it'll be traded directly with a fund manager. So the way these things are traded, the way they're priced is quite different. But if you look at the long-term return, then they'll be very, very similar. Day to day, there will be differences, but they'll probably be quite small. There are also tax differences. In the UK, certainly, there are different holding fees. So if you hold OEICs, open-ended investment companies, they're on many platforms, they're more expensive to hold than ETFs. But really, it depends on your domicile. It depends on the tax will be affected as well, according to the wrapper, whether it's an OEIC or an ETF. All of these things will be affected. In the US, ETFs are very popular because you never have to trade the underlying thing. You never have to sell the underlying thing. Think of it like trading chits, right? So if you want to buy a barrel of oil, you could just do it with a piece of paper that says, I'm Jack, I own this barrel of oil, or I'm Ramin, and I own this barrel of oil. And you could sell me your ticket. Well, we never actually sold the barrel of oil, right? If that was a situation. And that's why in the US, ETFs are traded very much, the stocks inside them are traded very much like the chit system, where it's just a piece of paper that says you own it now, or I don't. And that way they're very tax efficient, whereas traditional funds don't have that tax optimality. So that's why it's been very popular in the US. In the UK, actually, it makes no difference from a tax perspective. People just like ETFs, I guess.
I think you've mentioned somewhere in one of the interviews that you're using funds like Vanguard FTSE All World. For example, in Europe, at least, there's a ETF with the ticker VWRP. I wanted to ask you what makes a good global ETF and what should investors look for?
I think when it's a global fund, they're commoditized, right? It's one world you can buy. So it's the fee. How much are you paying for this fund? There are actually more subtle things to consider, which we can certainly talk about, which is how the fund tracks the index. And there are certain tax efficiencies which you can get if you use derivatives to track the index rather than buying the actual stocks. So there's something called withholding tax, where if you buy an Irish domiciled ETF, well, then if that ETF buys US stocks and those US stocks pay a dividend, then what matters in terms of the dividend you're paid is what's the withholding tax for Irish investors investing in the US, which is 15%. So 15% of the dividend will be lost. But if you go for something called a synthetic ETF, well, there the fund manager, instead of investing your money in US stocks directly, will enter a total return swap with an investment bank who sits on the exchange in New York and doesn't pay withholding tax. And then they pass that return to you as if you owned it. Well, they actually pass it to the fund manager who passes it to you. And that way you keep all of the dividend. So in theory, these things should generate much higher returns long term because you keep all the dividend. Some people don't like them because they've got derivatives inside them, and derivatives are scary. I mean, personally, I don't have an issue with that, but it's certainly a concern because your counterparty risk then exists, whereas with an ETF, you don't have counterparty risk. But to first order, cost, right? I think that's the most important thing.
So would you recommend synthetic replication versus physical just to reduce that cost, and in that case to reduce the withholding tax?
Yeah, I mean, personally, I'm comfortable with that risk. Not everyone is. You know, some people will say, look, I don't want that counterparty risk. I'll just go for the straight physically replicated ETF. And that's fine. But understand that you'll be giving up some of the return by doing that. Also, if you look at the expense ratio of some of these funds, the swap is priced separately from the expense ratio of the fund itself. So just double check what the swap fee is. You may be paying more than you think. But, you know, once these things are kind of taken into consideration, ultimately it's, do you worry about a systemic banking crisis? Because if you did, then you wouldn't want the counterparty risk, because usually it's investment banks who create these swaps.
Are there maybe other fees investors should be aware of when choosing ETFs? We mentioned just the management fees. We mentioned just this withholding stuff, withholding tax. Are there any other costs we should take into consideration?
I mean, if you go for a hedged fund where it's currency hedged, you may pay for the currency hedge. Another consideration with a currency hedge, actually, weirdly, is the interest rate differential between your country and the country where you're hedging the currency into. So if your interest rates are generally lower than the country where you're buying the stuff, then there'll be a drag based on that interest rate differential. So for Euro investors, for a long time, the US rates were much higher than in Europe. So if you've got a Euro hedged US equity fund, you are paying that drag in the difference between the rates. So just be aware of that kind of thing. It won't appear in the fee for the overall fund, but you'll certainly pay that difference if you go for the currency hedge. So that's a kind of implicit expense. Plus, you have to have a holding fee. So when you buy the ETF on a platform, you'll be paying the platform a holding fee. So it's good to know what that holding fee is. That varies between platforms. Some don't charge one, some do. So be aware of that. And then when you trade it, there's a bid offer spread. You buy low, you sell high if you could. But that's what the market makers do. They buy low and sell high, which means you buy high and sell low. So that's the problem, right? If you trade a lot, you're going to have to cross that bid offer spread all the time. And that could certainly wipe out some of your profits. I mean, generally, long-term investors don't do that anyway. But bid offer spread is important if it's a small fund, because those tend to have the biggest differences between the buying and selling prices. For a big ETF, which is in the billions of assets under management, it'll be tiny. It'll be a fraction of a percent. But for illiquid, newly created funds, it could actually be, maybe a quarter of a percent if it was really large. It depends on the fund.
You mentioned the global funds multiple times, but the fact is that the United States are representing about over 60% of global markets. Is this figure, maybe on this concentration, a concern?
Well, historically, remember that the US has been 50 to 75% of global equity markets over the last century. So that's not unusual. What is unusual at the moment is that the US is so concentrated in just a handful of names. Now, that is pretty worrying, because it's worrying in one way, which is that if the narrative changes, if AI suddenly shifts focus and some incredible new technology is created in China or Indonesia or who knows, Europe, then suddenly all of those crazy valuations for US companies won't make sense anymore. So if the narrative collapses, so will the US equity market. So that's more worrying, I think, than the overall US dominance. There are now ex-US developed market funds which you can buy. So if you wanted to recreate a global index fund with very few moving parts, you'd have developed ex-US, you'd have US, and you'd have emerging markets. So that would reproduce the world with just 3 funds, right? Quite easy to do. All low fee, all very simple. And then you could tilt away from the US, move money into developed ex-US or EM. Personally, I don't do that because I'd go back to my original point, which is that whenever I try to be clever, markets have a way of just showing me that I'm not. So, if I were to tilt away from the US, I'm sure something would happen to make sure that the US outperformed.
In the do-it-yourself asset allocation course, you are also covering rebalancing. And I wanted to ask you, how often should ETF investors, if they build their portfolios out of ETFs, how often they should rebalance the portfolios and what triggers should they watch for?
There's lots of research on this, and the general principle is as little as possible. So there are a couple of ways to do this. You can do it on a calendar basis, every month, every year. Generally, once a year is usually enough. Secondly, you can look at how much the weights in your portfolio deviate from your target weights. So if they cross a certain threshold, let's say 5 percentage points away from what you want. So let's say you start off 60% equity, 40% bonds, and then equity rallies, it goes to 65, and then bonds go to 35. Well, that's the point at which you buy a bit more of the bonds and sell some of the equity to pay for it. So, yeah, generally the principle seems to be less frequent is good, and the bigger the bands, the better. But at a certain point, the reason why you rebalance is because firstly, you're buying the cheap stuff and selling the expensive stuff, so you lock in profits that way. It can increase your returns a little bit. But generally, it doesn't make a huge difference to return. What it does make a big difference to is risk. So if you go to, you could start off with 50-50 equity and bonds, and after 30 years, you'll have a portfolio that's almost all equity because equity just grows faster. And that might not be a risk you're comfortable with. So I think in terms of risk, it makes sense to rebalance, but don't get too hung up on rebalancing because you just don't have to do it that often. And the less funds you've got, the easier it is. If you've just got one fund, you don't rebalance. If you've got 2, well, you just sell a bit of this one and buy that one. It's very easy. If you've got 20 funds and stocks and really complex investments, then it gets tricky.
And what do you think about ETFs, so-called multi-asset? Like in Europe, for example, we have from Vanguard Life Strategy, and that's like investing on autopilot. Do you like this approach?
In some ways, yes. I think for beginners, it kind of makes sense to have an off-the-shelf investment where all you have to think about is how much do I want in equity and bonds, and I'll just choose Life Strategy 80. So I've got 80% equity, 20% bonds. I know it's crashy, but the return's better long-term, probably. So I think that's fine for people who are just starting out. There are certain situations where it's not fine, and that would be in one of these rebalancing situations. So let's say that you're in retirement and you have a life strategy 60-40, so 60% equity, 40% bonds, equity markets halve. Okay. Now, the life strategy funds rebalance every day, which is fine, but remember that you have to sell some of the fund to eat. And if you have to sell the whole fund, well, you're selling the equity, which has crashed, alongside the bonds, which haven't. Whereas if you had 2 different funds, you could live off the bonds. You could just sell the bonds, let the equity to allow it to recover. And that way you wouldn't deplete your pot as quickly. Whereas the daily rebalanced fund, you don't have the optionality about which one to sell. So you're giving up optionality, which I think in retirement isn't such a good thing. In the accumulation phase, that's fine. It's probably not going to make a huge difference. But yeah, in retirement, I think it's probably best to split out the risky and non-risky investments.
Understand. You've done extensive work on bonds, and actually, I see you as an expert in bonds. And I think that also, at least from my observations, bonds are quite difficult to understand for many people. How do bond ETF fit into a beginner's portfolio, and when should someone consider adding them to portfolio?
Okay, so bonds are a broad church, right? There's a very broad number of bond funds. I'd say if you're just starting out, go for a global bond fund. And there's an index, which is a global bond index called the Bloomberg Aggregate Index, which is like FTSE All World or MSCI All Country World Index. It's a global bond index. So there again, you're buying a global diversified bond fund. I think what's special about fixed income is the safe stuff is usually the bonds issued by your government. Now, that's not to say they're completely safe. They're not, because of the duration risk. If you can buy single bonds, which you can in the UK, you can in Poland, you can buy single government bonds. What you can do is kind of magical because you can just hold them to maturity. That means the day you buy the bond, you know precisely what yield it's going to generate, and that's locked in. And nothing's going to happen other than the government. One sec. And nothing's going to happen except for the government defaulting on its debt, which is very unlikely in developed markets, which would stop you getting your money back. So that's what's magical about owning single government bonds. You lock in a rate, it's guaranteed, it's very low risk. You can look at the cash flows, you know when they'll happen, you know the day it'll happen, how much you'll be paid, and you know your overall return very closely. So I think those are very special. And I think for fixed income investors, once you get beyond a certain level of knowledge, you should try out buying single government bonds in your country. Understand yield, understand the clean price, dirty price, accrued coupon, all of this good stuff, because it's an incredibly valuable tool in your investor's toolkit. Not for beginners. There, a global index fund probably makes sense, but certainly once you've got a bit of experience under your belt, particularly for retirees.
After many years working in investment banking, also including as a strategist at UBS, what's, in your view, the biggest misconception retail investors have about how markets really work?
Well, just speaking to people after I left investment banking, I think the first shock was that people didn't realize they were being charged fees. You know, you ask the average person and, you know, they look at the City of London and the skyscrapers, the marble, the gold in the foyer. Well, actually, you paid for that. You know, that's what people forget. And I think it's important to understand the fee structure because those fees will determine what behavior the financial industry will try and make you do. So let's say it's an advisor. Now, an advisor will charge a percentage fee, which means it's an asset gathering business. The more money they gather into their big bucket, the more money they make. The less they speak to you, the less their costs. So immediately you know what the incentives are of that fund manager or of that advisor from the fee structure. So I think having that knowledge of how fees are made immediately tells you what you should do, which is usually the opposite of what they want you to do. If it's your broker, they make money on trades sometimes, so they want you to trade a lot. So you do the opposite, right? You don't trade. You don't give them your money. You keep your money. It's there to make you rich, not them rich. So I think that was the big misunderstanding, the biggest one.
Your YouTube channel, Ramin, has over 200,000 subscribers at the moment and millions of views. I wanted to ask you, what's been the most rewarding part of building this educational platform?
I think it's some of the feedback I get, which really makes all of it worthwhile. You know, people tell me, look, I didn't understand government bonds until I saw your channel. Now I do, and it's part of my portfolio. Or you've completely changed my life because, you know, I was being ripped off by my advisor who told me these things, which I didn't think I understood. but I just went along with it. Now I understand it. My advisors fired me. So their actual advisor didn't want them as a client because they were pushing back, because they understood what it was that they'd been given. So I think that for me was a big success. And then, the stories about how people have managed to generate really good returns when in the past they wouldn't have taken enough risk. That kind of story really is what keeps me going. Because, I've reached a point now where it is optional. I could retire at this point, but the reason why I carry on doing it is because it really is changing people's lives. And while I stay relevant, I'll carry on making the videos.
You've written a financial bestiary book. Can you tell us about this book and what inspired you to write it?
Yeah, I was traveling 2 hours a day on the tube, right? So you can either sleep on the tube, pass out and dribble next to your fellow suffering travelers and commuters, or I thought, well, what I do is I'll capture the knowledge which I'm picking up at the investment bank and I'll condense it into a book so that it's kind of like if I could travel back in time and educate myself about investment banking and finance. This is what I tell my physicist self 6 years previously. So that's what I tried to do. And I started it off with a picture book. I'd speak to people at the bank and I'd say, look, would you be in my book? I'd speak to a trader, a salesperson, a debt structuring guy, a back office risk guy who does market risk. All of these jobs, it's people that do them, but people don't understand what they do. So I got them to explain what they do. So that was part of the bestiary. Those are the parts of the animals in the book. And then the other animals were the actual products that we traded. Things like equity, obviously, bonds, credit derivatives, interest rate derivatives, currency derivatives, all of this stuff. I treated like animals at the zoo. That's why it was called a bestiary. So
Yeah,
that was why I wrote the book. And it was fun to write, It was fun rather than sleeping on the tube.
You emphasize being unaffiliated with financial products. Why is this independence so important to your educational mission?
Well, I think if people want you to give an objective opinion, I think it's really important to have that level of distance between yourself and the products that you're talking about. So we are very careful, particularly when we take a sponsor, because we are sponsored for some of the stuff we do by platforms, sometimes asset managers, but it's got to be really clearly stated up front who the person is that's, funding this video. But I think one of the choices you have to make as someone who runs one of these YouTube channels is how are you going to fund yourself? Are you going to take sponsorships? Who are you going to take it from? And can you afford to run the channel without doing it? So I think those are the considerations. But as long as you're completely transparent about who's paying for what, I think it's okay. But yeah, we are sponsored by some of these companies. But, would I make a video about a platform or including a platform advertisement that I didn't believe in? No. And you'll notice that we make very few crypto videos, and we're almost daily approached by crypto companies to advertise, and we almost exclusively say no.
All right. What's your ultimate goal for PensionCraft? What do you see not only your platform, but in general financial education? Where is it heading in the next decade, for example?
Yeah, I think a certain amount of work is done by AI now. So people often tell me, this is what AI told me. Is it right? Sometimes it's not, which is kind of shocking. But I think the kind of basic stuff, what is an ETF? How do I calculate return? Or, sometimes quite complex questions. Those can be answered by ChatGPT. I think what ChatGPT doesn't have is a kind of human aspect where people like having someone that they trust. So I think that's the problem with AI at the moment, which is that you can't always trust it. There might be issues with some of the things it says. And I think some people prefer to have a human who has not led them astray in the past, right? So that's the reason why people, I think, watch our channel.
Where can our listeners find more of your content and educational resources? What would you recommend as the next step?
Yeah, so look at our free stuff. Most of what we do is free. Look at Pension Craft, which is our YouTube channel. We've got a podcast, which is more informal, which is, a lot of joking, a lot of fun. Myself and Michael Pugh, who's the co-host, we make that every week, and it's called Many Happy Returns. You can see the pun on words there. And we've also got a free weekly market roundup that we publish every Friday, which we try to also be witty in. It's a difficult subject, so I think a bit of humor actually helps, which is why the podcast and the newsletter is probably good. I always feel in the YouTube videos that I'm being quite formal because I have to get this stuff across in as short a space of time as possible. Whereas with a podcast, you can take more time, as we have today, and people can get to know you better, I think. And if they want to join our community, that's our kind of paid offering. You can go to pensioncraft.com/membership and you can sign up there. And you'll also see what you get as a member.
Okay, I will put all the links in the show notes. Ramin, thank you so much for this inspiring conversation and for sharing your expertise. And if listeners take just one thing away from today, I would say that let it keep it simple, stay persistent, and maybe avoid checking your ETF prices just right before bedtime. Thanks again for joining us. Wishing you continued success, and until next time.
Take care. Thank you very much for the interview.